A number of the most prominent executives and CEOs in finance have recently come out with terrifying warnings about where the economy could be about to go next, in which we could really start to see a number of critical systems become strained to the point where they become outright broken. Larry Fink, the CEO of BlackRock, has been very vocal recently about the way the economy is heading after the yield on 10-year US Treasuries hit 4.58%, warning about what could happen if rates and yields go much higher. He believes that 10-year yields are going to climb to at least 5% due to embedded inflation, and he also adds that we're underestimating the change in geopolitics is so structurally inflationary. Now, without a doubt, the geopolitical events that have been taking place in recent years, particularly the Russia-Ukraine situation, are putting strain on global supply chains. And the surge that we have seen this year in 10-year Treasury yields has largely been driven by aggressive Federal Reserve interest rate hikes, with the latest move up caused by a clear message that rates will stay higher for longer to keep inflation under control. And added to this is the backdrop of increased US government borrowing to fund budget deficits, Fitch Ratings stripping the US of its top credit grade, and a sharp rise in oil prices that have all renewed fears around persistent inflation. Now, US government debt is breaking new highs every week, and with it comes surging interest payments on this debt. These ever-rising interest payments are eating away at the tax income that is being generated, and it now accounts for a whopping 11% of all government spending. Now, Larry Fink is not the first prominent Wall Street figure to warn about the risk of higher rates and bond yields, and Pershing Square Capital's Bill Ackman has also warned of the scenario of 30-year Treasury yields reaching 5%. And Thierry Wisman, Director of Global Currencies at Macquarie Futures, did say we could see something break when you see this kind of volatility on Bloomberg TV last week. And we've also recently had Jamie Dimon, the CEO of JPMorgan, issue a truly frightening warning about the carnage that could occur if interest rates do rise to 7%, and says that this is still a very possible scenario. Dimon is apparently telling clients to prepare for a worst-case scenario of benchmark interest rates hitting 7%, along with persistent stagflation in the economy, saying that a hard landing remains a risk for the US economy. Now, in this interview with the Times of India, he does say, "We urge our clients to be prepared for that kind of stress, and if they're going to have lower volumes and higher rates, there will be stress in the system. Warren Buffett says you find out who is swimming naked when the tide goes out. That will be the tide going out." Now, Dimon has also emphasised the fact that there is a big difference between rates rising from 5% to 7% compared to rising from 3% to 5%, as it would be much more painful for the economy, and he even did say, "I am not sure if the world is prepared for 7%. But he does believe that it may be a necessary move the Fed needs to make to continue the fight against inflation. And also, Charlie Jameson, Chief Investment Officer at Jameson Coote Bonds, told Bloomberg last week, "The world is certainly not prepared for a 7% Federal Reserve funds rate. At that level, we would expect to have a deflationary asset unwind, it would burst a lot of bubbles, and it would just simply not be sustainable." Already, economists are putting the probability of a US recession over the next 12 months at 55%. So interest rates rising to 7% would undoubtedly increase this likelihood and have serious implications for US businesses as well as consumers. So with the Fed refusing to push back against rising yields and tunnel visioning on continuing to fight inflation at the expense of economic growth, there are mounting fears about the consequences that this could cause further down the line. Now, JPMorgan's chief market strategist, Marko Kolanovic, has a scary historical comparison to what's going on right now with interest rates and bond yields, and that is the global financial crisis of 2008. He has pointed out that the increase in consumer loan rates over the past 2 years, in percentage terms, is about 5 times larger than the 2002 to 2008 period. The core risk for markets and the economy is tied to the interest rate shock of the past 18 months. History doesn't repeat, but it rhymes with 2008, he wrote in a note last week. Looking at this chart showing the interest rate of 48-month auto loans for commercial banks to consumers, we can see that between November 2021 and the latest data point of May 2023, the rate has increased from 4.58% to 7.59%. Now this is a growth of over 65% in less than 2 years, which greatly exceeds the growth seen between May 2004 and August 2006, from 6.43% to 7.95%. Now the same picture is painted as well for interest rates on credit card debt, which has risen at a rapid pace from 14.56% in February of 2022 to now being 20.68%. Again, this is a much sharper rise than the period before the global financial crisis. And perhaps the biggest discrepancy is the 30-year mortgage rate, which has risen from 2.65% in January of 2021 to now being at approximately 7.31%, a growth of 175%, which is absolutely insane. US consumer spending is showing clear signs of weakness and pain ahead, with consumer confidence slumping to a 4-month low thanks to a deteriorating outlook for the economy. Now, rising gas prices, persistent inflation, and looming student loan payments restarting are all contributing to the weakness to consumer confidence, which is a big blow to the economy considering the fact that spending fuels about 2/3 of the US economy. Most Americans now have less savings than before the pandemic, shown clearly by this savings rate chart. And credit card debt has reached a new all-time high, pushing credit card delinquency rates to the highest they have been for more than a decade. And we know that based on historical data, credit card delinquencies are strongly correlated with baseline interest rates. So if we do indeed see the interest rate surge even higher to 7% or above, then the delinquency problem is only going to get worse. This also puts pressure on consumer product companies, many of which are highly leveraged following a debt splurge in recent years, leaving them vulnerable according to Moody's Investor Service. Now, pressure on consumers can translate to credit trouble for these companies with heavy debt loads, and US retailers and supermarkets do face a looming maturity wall in the coming years. And now that student loans are about to restart for millions of Americans, the problem with weak consumer spending is only going to be exacerbated. 40 million people collectively owe more than $1.6 trillion in debt for student loans, and the average monthly payment will be approximately $300, which will be a noticeable hit to people's monthly budget. This money will have to come from somewhere, whether that means less eating out, fewer holidays, or putting off buying a home. Now, it is predicted that these loan repayments will cut back consumer spending by a further $100 billion annually, which could cause the US's economic output to drop by 0.1% in 2023 and 0.3% in 2024, according to Oxford economics researchers. We've also got the inevitable surge in unemployment looming over the economy, which is likely to begin to kick in next year in 2024. Now, the unemployment rate has historically correlated very strongly with the interest rate, but lags behind by a few years. And this means that the unemployment rate, which is currently at record low levels, is very likely to rise in the near future to mirror the surge in interest rates we've witnessed since 2022. And therefore, unless this period of time is an exception to what we've seen throughout the whole of history, then a surge in unemployment across the economy is coming in the future, which will harm consumer spending and the economy in general even more. Now, there is one sector of the market in particular that is being shorted particularly heavily by large hedge funds, with many predicting a complete collapse in the coming years. I cover this in more detail in my latest video, which you can check out on screen right now. Aside from that, please do leave a like on the video and subscribe if you enjoyed it. That does help out the channel a lot. And apart from that, thanks a lot for watching.